Day 24 of the series. So let's continue with globalization of stock markets 3.6. Figure 3.7 shows that NYSE Euronext is by far the largest equity market as measured by the total market value of listed firms. All major stock markets today are effectively electronic. Security markets have come under increasing pressure in recent years to make international alliances or mergers. Much of this pressure is due to the impact of electronic trading. To a growing extent, traders view stock markets as computer networks that link them to other traders. There are increasingly fewer limits on the securities around the world that they can trade. Against this background, it becomes more important for exchanges to provide the cheapest and most efficient mechanism by which trades can be executed and cleared. This argues for global alliances that can facilitate the nuts and bolts of the cross-border trading and benefit from economies of scale. Exchanges feel that they eventually need to offer the 24-hour global markets and platforms that allow trading of different types of securities. For example, both stocks and derivatives. Finally, companies want to be able to go beyond national borders when they wish to raise capital. These pressures have resulted in a broad trend towards market consolidation. In the US, the NYSE merged with the Archipelago ECN in 2006. And in 2008, it acquired the American Stock Exchange. In Europe, Euronext was formed by the merger of the Paris, Brussels, Lisbon, and Amsterdam exchanges, and shortly thereafter purchased LIF. The derivatives exchanges based in London, the NYSE Group and Euronext, merged in 2007 and was itself acquired by ICE in 2013. Nasdaq acquired Instinet, which operated another major ECN INET in 2005, and the Boston Stock Exchange in 2007. It merged with OMX, which operates even 7 Nordic and Baltic stock exchanges, to form Nasdaq OMX Group in 2007. In the derivatives market, the Chicago Mercantile Exchange acquired the Chicago Board of Trade in 2007 and the New York Mercantile Exchange in 2008, thus moving almost all futures trading in the US onto one exchange. In 2008, Eurex took over International Securities Exchange ISE to form a major options exchange. So the figure 3.7, the biggest stock markets in the world by domestic market capitalization 2015. So as we can see, the NYSE is by far the biggest, more than doubling the second biggest, which is the Nasdaq OMX. So NYSE is at around about almost $17,000 billion, which is $17 trillion. And then the Nasdaq OMX is around $7 trillion. And then we have Japan, London, Shanghai, Euronext Europe, Hong Kong, Shenzhen, Deutsche, TMX, Toronto, SIX6, Swiss, BSE, India, Korea. Actually surprised to see India on there, but yeah, India has about $1 trillion in BSE. Now we move on to the 3.7 trading costs. Part of the cost of trading security is obvious and explicit. Your broker must be paid a commission. Individuals may choose from two kinds of brokers: full service or discount brokers. Full service brokers, who provide variety of services, often are referred to as accountant executives or financial consultants. Besides carrying out the basic services of executing orders, holding securities for safekeeping, extending margin loans, and facilitating short sales, brokers routinely provide information and advice relating to investment alternatives. Full service brokers usually depend on a research staff that prepares analysis and forecasts of general economic as well as industry and company conditions, and often make specific buy or sell recommendations. Some customers take the ultimate leap of faith and allow a full service broker to make buy and sell decisions for them by establishing a discretionary account. In this account, the broker can buy and sell pre-specified securities whenever deemed fit. The broker cannot withdraw any funds though. This action requires an unusual degree of trust on the part of the customer, for an unscrupulous broker can churn an account, that is, trade securities excessively with the sole purpose of generating commissions. Discount brokers, on the other hand, provide no frills services. They buy and sell securities, hold them for safekeeping, offer margin loans, facilitate short sales, that is all. So basically, full service brokers, it's required a lot of trust from the part of the customer, because like full service brokers have a lot of power in terms of withdrawing any amount of money for any trades, and they can churn an account, that is, trade securities excessively with the sole purpose of generating commissions. So that is possible, and that's why there has to be a lot of trust between the customer and the full service broker, otherwise it's no point. Discount brokers, on the other hand, provide no frills services. They buy and sell securities, hold them for safekeeping, offer margin loans, facilitate short sales, that is all. The only information they provide, the securities they handle, is price quotations. Discount brokerage services have become increasingly available in recent years. Many banks, thrift institutions, and mutual fund management companies now offer such services to the investing public as part of a general trend towards the creation of one-stop financial supermarkets. Stock trading fees have fallen steadily over the last decade, and discount brokerage firms such as Schwab, E-Trade, uh, TD, Ameritrade now offer commissions below $10. In addition to the explicit part of trading costs, the broker's commission, there's an implicit part, the dealer's bid ask spread. Sometimes the broker is also a dealer in the security being traded and charges no commission, but instead collects the fee entirely in the form of the bid ask spread. Another implicit cost is trading that some observers would distinguish is the price concession an investor may be forced to make in trading in quantities greater than those associated with the posted bid or ask price. Buying on margin. When purchasing securities, investors have easy access to a source of debt financing called brokers' call loans. This act of taking advantage of brokers' call loans is called buying on margin. Purchasing stocks on margin means that the investor borrows part of the purchase price of the stock from the broker. The margin on the account is the portion of the purchase price contributed by the investor. The remainder is borrowed from the broker. Brokers in turn borrow money from banks at the call money rate to finance these purchases. They then charge their clients that rate defined in Chapter 2 plus a service charge for the loan. All securities purchased on margin must be maintained with the brokerage firm in street name, for the securities are collateral for the loan. The Board of Governors of the Federal Reserve System limits the extent to which stock purchases can be financed using margin loans. The current initial margin requirement is 50%, meaning that at least 50% of the purchase price must be paid for in cash with the rest borrowed. If the stock value in example 3.1 were to fall below $4,000, owner's equity would become negative, meaning the value of the stock is no longer sufficient collateral to cover the loan from the broker. So let's read example 3.1. Margin. The percentage margin is defined as the ratio of the net worth or the equity value of the account to the market value of the securities. To demonstrate, suppose an investor initially pays $6,000 towards the purchase of $10,000 worth of stock, 100 shares at $100 per share. Borrowing the remaining $4,000 from the broker. The initial balance sheet looks like this. Assets, value of the stock, $10,000. Liabilities, loan from broker, $4,000, equity, $6,000. The initial percentage margin is margin equals to equity in account divided by value of stock. 6,000 by $10,000 equals to 60%. If the price declines to $70 per share, the amount becomes 7,000, 4,000, 3,000. The assets in the account fall by the full decrease in the stock value as is the equity. The percentage margin is now 43%. Example 3.2, maintenance margin. Continuing the scenario presented in example 3.1, suppose the maintenance margin is 30%. How far could the stock price fall before the investor would get a margin call? This is what margin call means. It's pretty interesting. Let P be the price of the stock. There's a neuron activation right there because the word margin call. Favorite movie. Anyways, let P be the price of the stock. The value of investor is 100 shares and is then 100P. And the equity in the account is 100P minus $4,000. The percentage margin is 100P minus $4,000 divided by 100P. The price at which the percentage margin equals the maintenance margin of 0.3 is found by solving the equation. 100P minus 4,000 divided by 100P equals to 0.3, which implies that P equals to $57.14. If the price of the stock were to fall below $57.14 per share, the investor would get a margin call. Concept check 3.4. Suppose the maintenance margin in example 3.2 is 40%. How far can the stock price fall before the investor gets a margin call? So to solve this, we would just replace 0.3 with 0.4, which would mean 100P minus 4,000 divided by 100P equals to 0.4. So 100P minus 4,000 equals to 40P. So 60P equals to 4,000. So P equals to 400 by 6, which is 66.6 bar. So 66.66. So the answer is 66.6 bar. 6x to round off. So yeah, let's just continue reading this. To guard against this possibility, the broker sets a maintenance margin. If the percentage margin falls below the maintenance margin, the broker will issue a margin call, which requires the investor to add a new cash or securities to the margin account. If the investor does not act, the broker may sell securities from the account to pay off enough of the loan to restore percentage margin to an acceptable level. Why do investors buy securities on margin? They do so because they wish to invest an amount greater than their own money allows. Thus, they can achieve greater upside potential, but they also expose themselves to greater downside risk. To see how, let's suppose an investor is bullish on FinCorp stock, which is selling for $100 per share. An investor with $10,000 to invest expects FinCorp to go up in price by 30% during the next year, ignoring any dividends. The expected rate of return would be 30% if the investor invested $10,000 to buy 100 shares. But now assume the investor borrows another $10,000 from the broker and invests in FinCorp too. The total investment would be $20,000 for 200 shares. Assuming an interest rate on margin loan of 9% per year, what will the investor's rate of return be? Again, ignoring dividends, if the stock price increases 30% by the year's end, the 200 shares will be worth $26,000, paying off $10,900 of principal and interest on the margin loan. That leaves $15,000, $15,100. That is 26,000 minus $10,000, $10,900. The rate of return in this case will be $15,100 minus $10,000 divided by 10,000, which is 51%. So instead of the first 30%, you're getting 51%. The investor has parlayed a 30% rise in the stock price, 30% rise in the stock price into a 51% rate of return on the $10,000 investment. Doing so, however, magnifies the downside risk. Suppose that instead of going up by 30%, the stock price drops by 30% to $70 per share. In that case, the 200 shares will be worth $14,000 and the investor is left with $3,100 after paying off $10,900 of principal and interest on the loan. The result is a disastrous return of negative 69%. Huh. I don't think I can do this without a computer, and my laptop right now is at home being serviced. I'll go and collect it tomorrow, so I don't have it today, but I'll still read it to see if I can do it without the laptop. Excel applications buying on margin. The following Excel spreadsheet available in Connect or through your course instructor makes it easy to analyze the impacts of different margin levels and the volatility of stock prices. It also allows you to compare return on investment for a margin trade with a trade using no borrowed funds. Excel questions. 1. Suppose you buy 100 shares of stock initially selling for $50, borrowing 25% of the necessary funds from your broker, i.e. the initial margin on your purchase is 25%. You pay an interest of 8% on margin loans. Wait 1 second. 100 shares of stock initially selling for $50. Okay, so $500 worth of shares, borrowing 25% of the necessary funds from your broker. So $125 you borrowed. Initial margin on your purchase is 25%. Okay. You pay interest rate of 8% on margin loans. How much of your own money do you invest? So we invest $375. So I'll write that down. How much do you borrow from your broker? $125. What will be the rate of return for the following stock price at the end of a 1 year holding period? $40. So if it becomes $40, that'll be worth 400. We have to pay 125 times 8% of that. So 125 times 8 by 100. So this is 4, this is 5. 5 times 8, 40, 40 by 4, 10. So $10. Oh, well, 1 second. It's 5,000. Not bad. Yeah. Yeah, that's fine now. Doesn't matter. $100 is the interest. So that plus that, so 1350 we have to pay back. And if it becomes 4,000, so 4,000 minus 1350, that means 2,650. 2,650. 2,650 and 2,650. So 3. Yeah, we can't do this without the computer. So try doing it, but it doesn't work. Yeah, basically this only. 110 by 375, whatever that is. So 3, 330, 45. That seems wrong. Oh, it'll be like, yeah, times 100 anyways. So it's fine. 3.40 something. So like 34%, like minus 34%. Okay. So like this answer is like minus 34% something. Okay. Yeah, rest we'll do when I have my laptop, if I'll do it. But yeah, minus 34% is the return if the stock price falls to $40 after 50. Anyways, table 3.1 summarizes the possible results of these hypothetical transactions. If there's no change in the stock price, the investor loses 9% the cost of the loan because he has to pay the interest over the principal. So yeah, 3.1, the illustration of buying stock of margin, change in stock price, end of year value of shares, repayment of principal and interest, investors rate of return. Change in stock price, 30% increase, end of year value of shares 26,000, repayment of principal and interest 10,900, 10,900, 10,900, investor rate return 51%, minus 9, minus 69. As we can see what happens. So assuming the investor buys $20,000 worth of stock, buying 10,000, as purchase price interest of 9% per year. So that's done. Anyways, concept check 3.5. That was good. Good formulas, good questions. Covered some solid ground over there. Now concept check 3.5. Suppose that in the FinCorp example, the investor borrows only $5,000 at the same interest rate of 9% per year. What will the rate of return be if the stock price increases by 30%, if it falls by 30%, if it remains unchanged? So these are three different parts. Suppose in a FinCorp example, the investor borrows only $5,000 at the same interest rate of 9% per year. What will be the return if the stock price increases by 30%, falls by 30%, remains unchanged? So borrows only 5,000 instead of okay. So 9% of 5,000 will be $450. So 5,450 will be the PNI, principal and interest, equals to $5,450. And if it goes up by $3,000, and now they still $10,000, so $15,000, 30%. Jesus Christ. Yeah, 30%. So that's I need to do maths. 4,500. So like 19,500. 500. You take 5,450 out of that. How much you have left? 550. Wait 1 second. 550 and 3,550. 3,550, 4,050. I really can't do maths, huh? There you are. 14050. So the return is 4050 by 10,000 times 100, whatever the fuck this is. 2, 3, 4, 5, 40.5% for part A. And if it falls by 30%, oh yeah, okay. Okay. If it falls by 30%, then it will be, how much will it be? 1 second. 15,000 minus 4,500, so 10,500. 10,500 minus 5450. 10,500, 5450. 5050, and then that is yeah.